All right, welcome back to Investing Wizards. I have the great pleasure of having Jamin Ball, who is a VC investor at Redpoint Ventures, follows a bunch of SaaS stocks, and has some good ideas for us today. So thanks for being with us.
Yeah, thanks for having me. Happy to be here.
Awesome. So would love to start with just kind of your investment style. We have a lot of different investors on the show, public markets, macro investors. We've had VC investors on, but how do you think about your investment style when you're looking at stocks?
Yeah. You know, I would say it's kind of a couple different factors that I like to think through, and that I kind of apply to both kind of public and private type worlds. But I consider, I mean, at a high level, my style is, buy and hold. Right? Like I want to buy stocks that I want to kind of set it and forget it, maybe add to over time, and then not worry about managing on a day-to-day basis. I want to be in kind of great businesses, have a pretty concentrated portfolio of high conviction bets, and it's similar to what I do on the private side, right? Which is a couple investments a year, 1 to 2, that obviously we're buying and holding for a long time, given it's an illiquid market on the private side. But I kind of like to apply the same principles to kind of the public investing as well.
Okay. And does your fund invest in the public markets, or is it just you personally follow the public markets? How does that work?
Yeah. The latter. So we are strictly a private investing, investing in seed stage businesses through kind of pre-IPO rounds. We have an early stage fund that is usually more seed and Series A focused. And then parallel to that, we have a growth fund, which is where I spend all of my time. Sweet spot for us is going to be Series B's, Series C, and Series D financings. And then, anytime we have companies that go public, depending on kind of what we see as the outlook, we might hold it for a little bit before distributing back to our investors. But, generally we take the mindset of we're not public investors. We'll kind of average out over a year, 2 years kind of thing. But usually we're not, holding public stocks is not part of our strategy or how we think about, driving multiples of the fund.
Got it. So when you're looking at public stocks, are you using that just to kind of inform your view of the private markets on valuation and trends?
Yeah, maybe even the other way around. Actually, right? Where I would say where I'm really digging deep is on the private side, looking for opportunities, looking for big markets. And as a result of that, usually we get to figure out or develop a thesis around which incumbents do we think have soft underbellies, what macro trends are happening in the world that might leave someone exposed. But the flip side then is, right, we also get a view for which incumbents have a strong position or, maybe have kind of solidified themselves as a leader. And it's going to take kind of something special to, quote unquote, unseat them, right? And now too, which has been interesting. So I've been at Redpoint for about 4.5 years now. A lot of the companies that we look at and evaluate as private investments have gone public now and are trading, right? And so I can take some of my learnings and viewpoints from when we evaluated the businesses when they were private, and kind of carry over that thinking to them as public companies. And oftentimes I'm waiting for companies to go public so I can find a way. There's an easier way to invest, right? There's no barriers then.
Yeah. And are you allowed to invest personally in the public markets?
Yeah. I mean, there's the only time there are restrictions is if it's our own companies, right? So if we're investors, or if we're on the board, obviously we're, the same kind of rules and restrictions apply to us just around quiet periods and when we're able to buy, when we're able to sell. But once we're off the board and once we've kind of exited our position, then it's kind of, the shackles are off, I guess, if you will.
Have you ever shorted a company based on this kind of underbelly thesis, the weakest, the big incumbents?
I haven't. I maybe should. Like, there's been plenty of companies I've wanted to, either because I think they're too richly valued, or or right, there's up and comers that I think they're exposed to. Sometimes I may have been right, sometimes I may have been wrong, but I always just like to say, like, I'm not a professional public investor at all. I have no idea how to read a technical trading chart, right, or come to conclusions that way. I like to take more of the macro view on, hey, is this market big? Is this product best in class? And are they executing well, right? Does the financial profile look good? And if I can kind of check some of those boxes, I'll put some money in my Robinhood and, check back in a couple of years kind of thing.
That sounds like important factors to get right.
Yeah.
If you get those right, you'll make money.
Yeah.
And is that what you use? You use Robinhood?
Yeah, I use Robinhood. It's just easy. I like the interface. I was using E-Trade a while ago and then switched over to Robinhood. It's just an easy platform. And for someone who's not really doing much, right? Like, I don't really get involved, right, as I mentioned, in shorting or options or any of that. It's pretty kind of cut and dry. Hey, what stocks do I want to own? And I'll just get in that way.
Cool. So this is a good time to transition to some stock ideas and kind of look at some of the charts and trends. So let me share my screen here. So one thing I wanted to go over with you is, if I pull up here a scatter plot, I'm just going to pull up the WCLD, which is the Wisdom Tree Cloud Computing Index. Yeah. I know there's a lot of them here, but let's just do let's do EV to sales here, and on a forward basis, and we'll look at price performance year to date. Okay, and I'm just going to make this a little bit bigger. So I'd say there's a lot of kind of like interesting trends to highlight here. One is the spectrum of valuation here, which kind of goes from 0 to 40 times sales. Public market investors typically talk about kind of PE being from 0 to 40, but here we're talking about sales.
Right.
And then the other thing to kind of highlight is the most expensive companies are outperforming year to date, right? Kind of like the ones that are trading here, you definitely, if we were to draw a best fit line, you'd see kind of this upward sloping curve. So how are you thinking about the trends displayed on this little scatter plot?
Yeah, it's interesting. Yeah, the other interesting thing too is, a lot of these the multiples are fluid, right? Like, we're kind of looking at how they're trading now versus their kind of change throughout the year, and a number of these have changed over time. But what I would say is generally the most expensive names are kind of expensive for a reason, right? And if you look at these companies on the far right, Coupa, Cloudflare, Build.com, Datadog, Shopify, Okta, Zscaler, CrowdStrike, right? These are all kind of what I would consider best in class products, right? And when I'm looking at making investments both on the public and private side, it's kind of a couple factors. One, I'll look at the market. Is this a big and growing market that I think can support a large independent public company? Obviously the public company box is checked, in this screen when it's already public. Then I'll look at the product and say, hey, I really only want to be investing in the leading product in any given category. I think now more than ever we see a larger portion and percentage of market share accumulate to the leader in categories, as opposed to there being kind of multiple winners. There are cases where there are multiple winners, but I'd say more than ever it tends to accumulate to one winner. And then I'll look at like the financial profile, right? Is the business growing? Is it growing efficiently? Are their customers happy and buying more, right? I'll look at net retention. And I think if you were to look at all of these businesses, right, just kind of like where your mouse is, and to the right, like they all check that box, right? You look at, a CrowdStrike versus there's a couple competitors, we're actually investors in one called Sentinel One, on the private side, right? That's been doing quite well. But, you look at some of the other competitors, right? Silence, Carbon Black, right? They didn't make it public. They were, I guess Carbon Black did. But ultimately they were acquired, right? And kind of CrowdStrike has taken over, right? You look at Okta versus like a Ping Identity, you look at Datadog versus some of the other monitoring observability players like a Dynatrace or New Relic, or even Elastic. And, the winners and the leaders are on this far right side. And, when I'm thinking about investing in any of these, are these multiples high? Are they sustainable? Probably not. We're not going to see companies trade at, 30x plus forward revenue for long periods of time. There might be other factors in play now, right? There's zero interest rates basically and tons of stimulus money. And, there's probably an argument to be made that the baseline multiples have been reset higher. But, I always think of 10 to 15x and maybe 15 to 20x is for best in class to be the range. But when I look at these businesses, I want to hold them for, 3 to 5 years plus. And, if I think they're going to sustain growth rates, they may see some shorter term, or medium term pressure on their stock as multiples will inevitably come down at some point. But if you're growing fast enough, you can, quote unquote, grow into your multiple. And, over time, over my investment horizon, it's not as important to me what they're trading at now. It's more of kind of like, hey, do I believe this is a foundational business that is going to be around for the long term, right? Is this the next Salesforce? Is this the next Workday? Right? Just kind of like the foundational businesses that are going to be able to grow 25, 30% year over year for a decade. And if that's the case, 10 years from now, it doesn't really matter what happens to the multiple, within reason, right? Like the companies and stocks will perform well.
Got it. So because they have a best-in-class positioning leadership in their sector, even if you assume some multiple compression, the fundamentals growing kind of double digits, 20 to 30% a year is going to offset that multiple compression.
Yeah. And I think Shopify is a perfect example of this, right? And I've been kind of looking into them recently, so they, at the beginning of the year, they were trading in the 20s, right? Like, I guess you can see it right here. I mean, that pre-COVID high, if I just kind of go over, right? I mean, that was probably 25x, right? And right now it's, call it 31. And, like what's happened to their stock since then, right? I mean, it's doubled.
Right.
And in the interim, the multiple went up to 50, right? So you've seen a multiple basically go from, what does it peak at? 50, like 55, 55 to 30. And I think the stock peaked at maybe like 1100, something around that. And it's in the 900s now, so you saw the multiple compress by, what is that?
I'm just going to pull it up.
Yep. Yeah, like you see the multiple compressed by 40% and the stock price compressed by 15%. And that's what happens when you have a business that can grow as well as Shopify has grown, right? Yeah, I mean, you kind of look at the stock price there in this chart, and it almost just kind of looks like a horizontal grind over the last few months, while the multiples kind of come down from 55 to 30. And obviously Shopify is a bit of a unique beast just in terms of how quickly they're growing, right? Like not everyone's going to be growing like Shopify. They obviously have extreme COVID tailwinds as businesses look to kind of build an online and digital presence. But the same, we could see the same thing play out to a lesser extent with some of those businesses I've seen that I was mentioning earlier that we saw on the right-hand side of that EV to sales scatter plot, which is maybe not in one quarter, you'll see their multiple compress 40% and not much happen to the stock, but you zoom out over years, I think they'll be fine. Bill.com and Coupa are interesting ones, just in the sense that there's a lot more kind of market, I think, thesis around those and how they move into payments and become more fintech businesses and kind of capitalize on some of the business model opportunities there. But yeah, I mean, Cloudflare, I guess, in the FinTwit world, they've taken over Fastly within their respective markets, although both are great businesses. I mean, that might be a good example of one where there's, multiple companies that kind of started in the CDN space, moving more into kind of edge network stuff, right? But they do very similar things. Datadog and like a Dynatrace or Elastic as well. But I think if you look at both the multiple and the financial profile of a company like a Datadog versus the others, there's just a bigger difference, right? The best companies, the best products are winning more, and everything from their growth rate to their margins to their net retention numbers, it's all demonstrated in those.
Cool. That's a really nice high level overview of a bunch of these different businesses. So, if I believe we agreed that you're going to pick two businesses to talk about here.
Yeah.
And you told me that you wanted to talk about Datadog, which is over here.
Yeah.
And Twilio, which is over here.
Yeah.
So one thing I want to kind of like, before we hone in on both of them, Twilio is trading at half the multiple of Datadog. So does that, if you have to sort of like pick between, is this just a better value, or is Datadog that much of a better business?
It's interesting. One of the knocks, so they have a really different business model, and I think the reason Twilio, I'm pretty sure, the reason Twilio doesn't trade at a best in class multiple like the others is just kind of how their ultimate business works, right? So they have a lot of pass-through costs to telco providers, right? The ones who are actually providing the communication infrastructure. And so they have gross margins at around 50%. And ultimately, when you look at what $1 of revenue is worth, for a company like a Datadog or some of these others, who have gross margins like 80% around there, in theory, not all revenue dollars are created equal. And if Twilio is kind of passing through, about 50% of their revenue to the kind of communications infrastructure, it limits them in other regards, right? There's less that's going to flow through to free cash flow. There's less that's going to flow through to the rest of the business. They have to be hyper efficient on customer acquisition because of it. But the gross margin has always dinged Twilio in a big way, right? And so I think it's, I'm no expert on what businesses should or shouldn't trade at, but there's a very logical, I'd say, rationale for why it has a much lower multiple than some of these others. I mean, given the growth, the net expansion, and a lot of the payback, given the other stuff is quite good, relative to these others. But yeah, I like both businesses for different reasons. I mean, happy to kind of talk about either, double click on any of them, whatever makes the most sense.
Yeah, absolutely. And here you can see kind of this, what you mentioned here is Twilio in terms of gross margins at 50%, and Datadog much higher, kind of towards the top end of the range. So why don't we start with Twilio? If you can, why do you like the business? Why do you think long-term is going to be one of these kind of best in breed companies?
Yeah. I would say we've also had, a longer term view of Twilio. We're lucky enough to be investors in them, kind of in some of their private rounds. And so I've been around the business for a while, but I think the easiest way to think about it is everyone is going to want digital ways to communicate with their customers, or whoever their end constituents are, and building that functionality yourself. It's not always a core piece of your product, but it's an important one. And when you have those types of functionalities and products, a lot of the times it makes sense to go to a product like Twilio who can do it for you, right? And what we've seen with Twilio is, started with kind of chat and voice and video. Their recent acquisition of Segment, right, just kind of shows how they're moving in the direction of like, hey, we want to own all of the digital touch points with your customers and have a full holistic view of kind of all customer engagement, so you can digitally interact with them, or their kind of previous acquisitions. You see where they're going, and it's a business that it just feels like the future to me, right? So many customers are going to want to interact with their customers in kind of digital ways. And Twilio is kind of providing the infrastructure and the backbone to do just that.
Got it. And so Twilio provides kind of this communications infrastructure. And so can you talk about the rationale of acquiring Segment? And so like we're a customer, Koyfin is a customer of Twilio for the texting API side. How does Segment add to expanding that workflow for a company like Koyfin or one of their other companies?
Yeah. And I think the way to think about it is ultimately there's multiple points along a customer journey that you're going to want to engage with, right? And you want data around what those points are and when you should engage with them. And what Segment does is it allows Twilio to have a more kind of like end-to-end, or I guess to use an overused term, right? A holistic view of what those customer engagements and touch points are, so that they can then interact with them, whether it's with an email, whether it's with a chat, whether it's with a voice or video call at the kind of appropriate time, right? So the Segment stuff is really kind of giving them the tools to know when and where to interact with customers, and their existing product is going to give them the ability to do just that. So in many ways, it's just it's highly strategic. I think the market reacted very positively to it when it was announced. Generally, you see, a big acquisition with stock. A lot of the times the market will not react well, but like it jumped. But basically, it just gives them a lot more actionable insights into when and how to engage with their customers, and Twilio was able to do that through multiple different channels, through the depth of their kind of product offering. That in my mind, it's kind of highly accretive.
Got it.
And over the long run, who knows, right? It's Segment's more pure SaaS, right? They have high gross margins. It's also margin accretive, which maybe more on the kind of financial engineering side could be interesting, right? But yeah, and I mean other things too, right? Twilio is moving into the contact center. Something like this, you can combine tools for marketers, tools for support, tools for product teams. I think it all helps, and then just kind of adds to their overall market position.
Pretty amazing. COVID low, $10 billion, and now it's $42 billion. So
right. I think Twilio came out. They had a study, and obviously every study a company themselves is going to release is going to be a little self-serving, right? So you take it with a grain of salt. But their study was that through COVID, the couple weeks, months of COVID, back whenever they did the study, I think the number they quoted was it had accelerated their customers' digital communication strategies by 6 years. Right? Like everyone was just looking for digitally native ways to engage with their customers, and Twilio, in many regards, was the default kind of go-to for a lot of that.
Interesting. I spoke to a user several months ago who actually is a headhunter in the Bay Area, and he told me that one of the toughest places to recruit from is Twilio, because the management team and the leadership there has such a strong vision of the future, and it really kind of permeates throughout the entire company.
Yeah. No, and I think the high level tagline takeaway, right, is I think you used to think of Twilio as a communication business, and they're creating the leading kind of customer engagement platform, right? Which it's a big vision, and the execution has been there, which is important, right? It's not just about having a good product or a good team. You need to execute on the vision, and it seems like they've been doing that for years and years.
Interesting. Cool. Very interesting. And so let's move kind of to the other stock that you wanted to mention, which is Datadog.
Yeah.
So you just, sorry.
Oh yeah, go ahead.
No, I was going to say, can you just give us an overview of what the company does?
Yeah. So Datadog's another, I would say Datadog, put this in the bucket of businesses I have admired long before they were a public company, right? Over at Redpoint, we, wish and tried to be investors for a long time, and just never could. But yeah, I think Datadog is one of the kind of fundamental foundational enterprise software businesses out there. And the easy way to think about them is every business is running applications. Those applications run on infrastructure, and you need a way to monitor all of that, right? And so Datadog is started as a monitoring business for your infrastructure, right? So it's a way to monitor your servers, and everything on the back end to make sure things are running appropriately. They've moved into the APM space, the application performance monitoring space, which is, you think of kind of like an App Dynamics, right, which Cisco acquired. Then they also have a network monitoring product, right? So a company like a SolarWinds. So they've combined application monitoring with network monitoring with server monitoring into what it's called more of an observability suite. And then on top of that, they've also moved into logging, right? So you can kind of combine those 4 observability pillars with logging to do more kind of root cause analysis, look into exactly where the issues are. That's more of the Splunk territory. They have this platform where any business that is using any kind of cloud native modern architecture, or even not, you're going to need a way to monitor it, right? And the more cloud resources companies consume, right, the more AWS grows, the more GCP grows, the more Azure grows, you're going to need to monitor all that, right? And so in many ways, I view Datadog's growth and future outlook kind of directly correlated to the future outlook of kind of the cloud and cloud penetration. And that's something I think I'm extremely bullish on. I think we're in the very early innings of, and the more you build and grow, the more you're going to need to monitor. And Datadog has become the go-to platform for that, where you can kind of serve all of your monitoring and observability needs. And so it's one I've followed closely for a while, for a long time. They had a little bit of a tough reaction to their earnings yesterday or 2 days ago. Sometime this week. I think the market was expecting more of an acceleration of growth. But when I look at the fundamentals of the business, I mean, it's growing, 60, 70, 80% year over year on an LTM basis. I mean, the net retention is great. It's very efficient from a payback perspective. It's got a good margin profile. It checks all the boxes for me. And so that's one of my favorite, if not the favorite, buy hold for the long run, right? It was a day one IPO purchase for me. I think there's a lot of people who will dispute what is the right strategy of buying into recent IPOs. Do you wait till the lockup ends? Do you wait a couple months after the IPO once the price is stabilized? There are all these different strategies. For me, it was just one of those. I really don't care what entry price I'm getting at, whether it's, I'm just making up numbers now, right? Let's say it's $2 now or $4 now. If I think it's going to be 10x that in 5 years from now, that entry price doesn't matter to me. So it was one of the few stocks, just put a unlimited unlimited price order day one of the IPO, and I'm just going to let it ride for a while and add on kind of big down days over time.
Got it. So basically here, the company's $27 billion market company. In 5 years, that's going to be significantly higher, call it, 2, 3, 4, 5x higher. Kind of like the valuation or the noise here doesn't really matter if that thesis plays out, and it's going to grow multiple fold. Yeah,
that's my thesis. You're right. I could be right. I could be wrong. There's other factors that obviously affect what a company is worth outside of just kind of how they're growing. But yeah, it's, my take at least is that it will kind of continue to grow and be a best in class business for many years to come.
Got it. Okay. And you said you don't look at technical, so I will make a technical commentary here and this kind of like pattern here as it was trading here, and then it spikes on this big volume day and breaks out of this previous range. This is going to be a really important, like, it's unlikely to, and this is a lot of downside from 90 to 50, but this is kind of like a new regime. So whatever they reported here, and I don't know the stock, this is a pretty bullish chart, and the fact that it's kind of trading sideways but holding its levels and moving higher, so higher lows, higher highs, that's a really good sign. So love the way it looks from a technical perspective. And Jeff, I got to ask you, you probably ask this of your companies all the time as they're pitching you. What's stopping Microsoft or Amazon from like competing with these guys and really taking market share?
Yeah, it's interesting. Looking specifically at the kind of cloud giants, right? The Azures with Microsoft, the GCPs with Google, the AWS from Amazon. In many ways, there's a couple arguments. A lot of customers are multi-cloud. Are not just AWS or just GCP shop. So all the big cloud providers will provide monitoring tools for their environments. But the reality is you're going to be using other clouds, other infrastructure. AWS getting into APM, in that world or any of the other cloud providers, it's just a little bit kind of outside of their core competency. For monitoring and observability in particular, it's not something I totally worry about. The cloud providers, I'd say there are a number of businesses where you do, and you kind of wonder, hey, what's the threat here? I think Microsoft is getting into Twilio's world. And I think generally when you have these big companies, they might have more of a shot in, kind of like the commodity-ish type markets, but, generally a company like a Twilio, or other companies that are competing with Amazon products, they can be best of breed. And that matters, right? Like Snowflake might be a perfect example. And it's another one we've been kind of long-time investors in over at Redpoint, but I think there was an argument to be made. Why would anyone use a cloud data warehouse from a non-cloud provider, right? Why not use Redshift from Amazon or BigQuery from Google? Why not use the cloud data warehouse from one of the big cloud providers? That's what they do. That's their bread and butter.
Mm-hmm.
And early on, Snowflake was able to demonstrate like, hey, we are, one, the neutral third party. You can take data from any backend and put it into us. We can be multi-cloud, but two, we can be best of breed, right? And their original claim there, or their original product innovation was separating, kind of the compute and storage. So you could scale each one of those independent of the other. And that kind of proved to be just a huge and massive value prop for their customers. And they've become kind of like the de facto default independent cloud data warehouse now, right? And I think anyone can look at their financial profile and see that the growth will back that up.
So, yeah, I guess if we added Snowflake to the chart here on EV to sales, it would make everyone else look very cheap.
Right. They are, yeah. And there's definitely, they're within the lockup, all that. I should probably be like somewhat careful about what I say about Snowflake, given our relationship there. But yeah, it's trading at multiples, we've never seen in any software business.
Got it. And then if you were to buy one company, Datadog versus Twilio over the next 5 years, which would it be?
I like them both. I'd still say Datadog is probably my favorite business. And so I default to that one. I probably have a couple names in my like high conviction bucket. Datadog's probably at the top of it. So I'd go with Datadog.
It's pretty incredible. 3-year performance, almost the same.
Wow. Yeah.
And I don't think they have
Datadog, Datadog hasn't been public for quite that long.
Sorry, not 3 years. So yeah, so if I hit 5, it's actually going to start when it was public. But since its IPO, wow, that's pretty obviously both trouncing the Qs.
Yeah.
Cool. I've been to the Datadog office in New York for meetups, and they have a really nice office. And I love their logo. Their logo is amazing.
Oh yeah.
Cool. That's some great color on stocks and some of these companies. Really appreciate that. So closing segment, would love to first know, how do people follow your ideas if they want to kind of follow along in terms of what you're thinking?
Yeah. I've earlier this year, I just started getting a lot more active on Twitter. So that's the easiest point. It's a lot of just kind of my thoughts Right. So you can either follow along or not follow along, but that's going to be more kind of random day in, day out thoughts, either on companies or updates on companies or thoughts on valuation. That's the easiest way. I have a newsletter that I publish once a week. That is an update on, public SaaS companies, from valuations to earnings to performance to kind of other news. But yeah, the newsletter's Clouded Judgment. You can see it on my Twitter as well, but Twitter's probably the best place.
What's your Twitter handle?
It should just be at Jamin Ball.
Got it.
Yeah, I got lucky that I didn't have to add any numbers or hyphens or spaces.
not so many other Jamins around. Cool.
Exactly.
And I'll put the links to your Twitter handle and your Substack in the show notes as well. And then last question. Everyone's at home watching Netflix and other streaming services. Is there a show or movie that you've seen over the past couple months that you'd recommend and really like?
It's a good question. We were late to the party on this show, but my wife and I have loved Handmaid's Tale.
Okay.
We binged the first couple seasons. We're eagerly and waiting the next season, but we started watching it shortly after our oldest daughter was born, which definitely, it was an interesting time to be watching Handmaid's Tale with a new baby at home. But I've found that show quite intriguing.
My wife watches that show, and I've seen episodes, so I'll watch 2 episodes and then I won't watch 10. Yeah. And then I'll see one and be like, oh my God, what the hell is going on here?
Right. It's very different from other shows. It's just a very different storyline.
Yeah.
Plot. It's not your same old rom-com or Netflix special.
Yeah, definitely different. Cool. Well, really appreciate your time. Really appreciate your thoughts, and looking forward to following your stuff on Twitter and Substack.
Yeah, thanks for having me.